Good morning, one and all. Welcome to our morning session of the indirect tax paper, and we shall be continuing with the previous topic, that is valuations under customs. Before I proceed with the topic and the actual detailings, in case if any of you have any questions, queries relating to whatever was covered in the previous class, feel free to put a yes, students. Anybody? Any queries, doubts? Okay. Prithviraj says no queries. Yes, others, because this is a slightly technical topic. So in case if something is not clear, you require any particular point to be explained in detail, so that when I'm revising whatever we did, I can lay more emphasis on that part. No? Great. So what we are studying in this chapter is that once you have checked the customs tariff act, and from there it is clear that we are liable to compute the customs duty on the basis of value, because the rate given over there is a percentage of value. Then comes the most important part, that is determining the value. Now, custom valuation is not like our GST valuation, for the reason that in case of customs, we have to compulsorily follow the rules. We have to compulsorily check the rules. And compared to GST, here there are more conditions, and also there is more power with the custom authority when it comes to valuation. Just a sec, please. Sorry. So when it comes to customs valuation, it is more tricky, it is more detailed.
Sir, 2 minutes, please. There is some emergency in my place. Just give me 2 minutes. अशोक जी, आज थोड़ा मेरे यहाँ पे कुछ चैलेंज है। सो बीच बीच में जस्ट आई रिक्वेस्ट कि मेरे इधर से ऐसे कुछ डिसरप्शंस होंगे सर। फाइन। Sorry, students, kindly bear with today because of some exigency. I may be having to take up some calls in between if required. Fine. So, custom valuation is more tricky. Practically, also, it is very challenging, or if I can say, it is the most tedious part. And hence, when we are understanding the provisions, we have to ensure that we understand it with the same force, with the same brevity. So there are two ways in customs how duty can be computed. One is specific, where valuation will not be required because the duty is on the basis of physical attributes. So it will be expressed as per kg, per gram, etc. Ad valorem, where the duty will be expressed as a percentage of value. Example, if it is 10% of value, you multiply 10% with the appropriate value. Now the value on which this duty will be computed, the value is called as assessable value. Now the question is, what is this assessable value or how it will be derived? So for this, Section 14 of the Customs Act provides two mechanisms for arriving at the assessable value. First is tariff value. For certain specified goods, the government has itself derived a value. This value you have to adopt for the purpose of computing the customs duty, not for your business. Your business can happen at your negotiated value. This value is only for the purpose of custom duty computation. Now, barring those specific goods, notified goods, for all other goods, the law says the value will be transaction value subject to fulfilling some conditions given in the section itself and additional conditions given in the rules, and also subject to power given to the officer to, despite of you satisfying all the conditions, still reject your value. So subject to all this, your transaction value will be accepted. Besides this, even if your transaction value is accepted, the most important rule that we are going to study today is Rule 10, which says that you have to compulsorily add certain amount, certain cost, certain expenses to your transaction value so that this becomes the final assessable value. Now, let us proceed. So these are the different types of prices used in international. Drop your transaction value, you will have to keep it aside, and you will have to take the other values which are proposed in the valuation rules. Now, what are the basic conditions in the law itself for accepting the transaction value? So, firstly, it is describing what a transaction value is. For export also, for import also, both conditions are similar. I'll go for import. So it says it is your price actually paid payable. So it is your negotiated price for sale to India or for export to India. So this clarifies that this price cannot be domestic price of any of the countries, neither the exporting country from where the goods are coming. Let us say in my previous example, you are importing machinery from Germany. So neither that country's local price nor the local price in India of this machinery. It has to be the international price plus that manufacturer may be selling the same machine to different other importers across the globe. We cannot take the international price charged by that supplier to any other country's buyer. We have to compulsorily take the price when these goods are sold by that buyer for export to India. So it has to be our price meant for India. Second, the price should be at the time and place of importation. So this you'll come to know when we add the cost under Rule 10, that how we reach the price up to our place of importation, time and place. And then the two conditions, buyer seller should not be related and price should be the sole consideration. Then it says in order to make it the price at the time and place of importation, in order to make it a price up to the time and place of importation, you will have to add all these expenses so that the price becomes a price up to the place of importation. This is as per Rule 10 that we'll be studying. And then further it says that there will be rules which you have to compulsorily follow, and the rules will be providing for all these things. First, how to determine whether buyer and seller are related. Second, how to determine the value in respect of those cases where above conditions are not satisfied. That is, either there is no sale, you are importing it for yourself. So if no sale, there is no price. So no question of transaction value. Or if buyer seller related, or if price is not the sole consideration or for any other reason. In short, rules will also provide you for parallel mechanism of computing the value. Then the manner in which the officer may reject the value declared by you and despite of you satisfying all the conditions, and the additional conditions or obligations which is cast upon the importer which he has to compulsorily comply with, because the officer has the power to reject the value. Now, this power should not be used arbitrarily. Hence, a set of rules were provided very recently in 23, which provided guidelines as to how the the importer can provide additional details and avoid getting his value rejected. Most important part in section 14 is what will be the relevant date. Date for what? Date for deciding the rate of exchange. And second, whose rate of exchange has to be taken. So firstly, answering the second question, whose rate of exchange has to be taken? It will be the rate given by the CBIC. But it is not necessary that the CBIC itself will give the rate. It may also specify or direct you as to whose rate you have to adopt, like RBI's rate or any other rate. But generally, it is CBIC who gives the rate. In that case, maybe your actual transaction, when it will happen, you will get it converted through the bank using some rate, but you will not take your actual conversion rate, that is a rate given by the bank or the rate applicable in the stock market or in the common market. You will compulsorily take for custom valuation the rate given by the board. Then comes the relevant date. Now here, when we are talking about the relevant date, section 14 provides the relevant date of
rate of exchange. That is which date's exchange rate given by CBIC has to be taken. The date is only one, that is the date of your first bill of entry when you cleared the goods from the port. Now, this may be the final clearance or this may be clearance temporarily for depositing in warehouse. In any case, this is the rate or this is the date of which you take the exchange rate. Now, why I am emphasizing this? Because there is parallel another section, section 15, which we studied in the previous chapter, which provides that or which provides what will be the date for determining the rate of customs duty. Which is given in section 15 is for determining which date's custom duty rate you will adopt. Like how you have time of supply provisions. So section 15 is like time of supply provisions. Over there it is written, in case of import where you are going to clear the goods for home consumption immediately on its import, the relevant date of which the custom duty rate will apply is the date of entry inwards granted to the ship or the date of filing of your bill of entry, whichever is earlier. Second, if you are going to now remove the goods from port and keep it in warehouse, so you have already filed the first bill of entry, that date's rate is not taken. In that case, when you will find the second bill of entry, which is for clearing or removing the goods from warehouse for your home consumption, that is again the final clearance, that bill of entry date is relevant for determining the custom duty rate. So that is what is provided in section 15 relating to relevant date for determining the rate of custom duty in case of import. Similarly, what is the relevant date for determining the conversion rate in case of export? It is again the date of bill of export. So like how you have shipping bill for imports, for exports, you have the shipping bill or the bill of export. So the relevant date for the conversion rate or the foreign exchange rate is the date on which this bill of export shipping bill is filed. Even for custom duty rate in export, which is rarely there, you are given similar provisions. Tariff value wherever assigned, you have to take that value only. In that case, whatever we are going to study henceforth will not apply and will not be useful. Now, as we saw, the section itself says that you have to compulsorily go to the rules. Why? One, for additional conditions of transaction value, so that you can determine whether or not finally to take the transaction value as your assessable value. Two, even if transaction value is taken, it is acceptable. Still, what are the additions to be made in transaction value, which is given in rule 10, which we are going to study today. Next, rule 12 provides where the officer has power to reject your value. So these three things anyways will be required whenever you are doing valuation as per transaction value. Now, in case transaction value is rejected, then again the valuation rules are required, because from rule 4 to 9, it provides you the other mechanisms of how you can compute your value. Rule 10, most important rule that we are going to study today. Rule 11 is that importer has to give all declaration and also mention at the bottom that above conditions are met, all the required details are submitted, and whatever information is given is true and fair. Besides all this, the power is given to the officer to reject the value, and in case he rejects the value, means now the transaction value will be rejected. You have to adopt the other rules value. Rule 13 is important for understanding what is given in the above rules. You have to refer parallelly the interpretative notes given in Rule 13. Then we saw the three important definitions: goods of same class or kind. So here I gave you example of my shirt. So when I am importing a shirt, what will be goods of same class or kind? It will mean shirt is belonging to which industry? Textile. So whatever goods belong to textile industry become goods of the same class or kind. So this is a very wide concept. So it will include the other two concepts which you are going to study: identical goods, similar goods, plus those goods also which may not be exactly identical or similar but are forming part of the same industry. So even a t-shirt is goods of the same class or kind because it belongs to the same industry. Next, we do not take this as the basis for valuation. This is just a concept for your understanding. Now, what could be the basis for valuation in case your transaction value is rejected? So, the shirt which I have imported, let us say it is a Van Hussein shirt. I have imported it in 1,000 quantity for the purpose of my business. The transaction value of my shirt is rejected. In that case, when we'll proceed with the rules, it's a no problem. You take value of identical goods or you take value of similar goods. But the question is, what is identical and similar? So identical means same type of shirt. That is, I have imported Van Hussein, same Van Hussein shirt made by the same person sitting in Germany is purchased by some other importer in India. So obviously that importer is, you can say, my competitor, and he's in the same business. So like how I'm importing it for my business, he's also importing it for his business, but it is exactly the same. So same Van Hussein shirt, maybe slight difference in color, etc., which does not changes the value or does not affects the value. Second concept is of similar goods. Now, identical means the same Van Hussein shirt imported by some other importer. Similar goods means not the same Van Hussein shirt, but maybe Louis Phillips shirt or maybe shirt of some similar equally known brand and shirt which is similar to my shirt but belonging to some other brand and maybe slightly more different. My shirt may be a plain white shirt, that may be a printed shirt. So that shirt may not be exactly same like my shirt. So it is not the same Van Heusen shirt. It is shirt of some other manufacturer. Manufacturer means of some other brand, and maybe even different in terms of its physical appearance, looks, etc. But it is commercially interchangeable and is performing the same functions. Just
Sorry, students. So, similar goods are shirts, but not of the same brand, but of similar brand, that is having regard to quality reputation, they are similar. And most important, these shirts or these similar goods are such goods which can perform the same function and are commercially interchangeable. Means what? So I have imported Ben Hussein shirt. So if some other importers are importing Louis Philippe shirt or any other brand shirt, and it is having quality reputation which is similar to my shirt, and also it is commercially interchangeable, then it will be called as similar goods. What is commercially interchangeable? By in market, if I am demanding Ben Hussein shirt, if it is not available, I am ready to buy another shirt. This is what practically happens when you go to mall. Though you have preference of a brand, but you also can buy shirt. Now, what is the place of importation? It is the custom station where the goods are brought for being cleared for home consumption or for being removed. From there, I will be clearing it and let us say bringing it to my factory in Rajasthan. But first, when it is getting landed at Bombay port, from where it will be cleared, that place is the place of importation. So the first port where your goods will be unloaded. Then the definition of related person. This, students, you will find very much copy paste with the GST definition. In fact, GST definition is copy pasted from here. So who are said to be related person in the eyes of customs? One, directors, officer and their company. Second, partner and partnership firm, employer and employee. And then those persons who have invested in your company and hold at least 5% of your voting shares, that is equity shares, or the persons maybe with or without investment are able to control. So one of them is controlling the other, both of them are controlling related person. Your value will be the transaction value. So rule 3 again reiterate what section 14.1 said, that we are ready to take your transaction value, and now it puts some additional condition. So section 14 had only what condition? Buyer seller should not be related, price should be the sole consideration. Additional conditions are that the seller should not have put restriction on the buyer. What type of restriction he should not have put? As to how these goods after he has imported. So no restriction should be there, otherwise we will reject your transaction value. However, there is exception to this because some restrictions are allowed. Why? Because they are required by some law. So there may be some restriction which is already required by some law or authority. If that restriction is a legal restriction, even the exporter can put such restriction. Like in case of medicines, there is restriction. Also, such restriction, even the exporter will put. No harm in that. Second, further use these goods in my geographical designated area, which is let us say Rajasthan and MP. But equally, he has agreements with another person for Maharashtra, another person for Tamil Nadu, Karnataka, another person for Kerala, Andhra. So he may have multiple contracts and there should not be internal conflict. So he may put such a restriction, which is acceptable by customs, that I will not use or dispose the goods in a particular geographical area. And he may put those restrictions which many times are only put mechanically. Like if you see the direction to use of any product, there are so many things written which are many times either required by law, that is first point, or either required by practice or general usage, but it has no effect on the value. So he may put such restrictions, conditions, and it will be acceptable. So first point, additional condition for accepting transaction value, there are no restrictions as to the use or disposition of the goods. Second, the exporter should not have fixed such a price for which value cannot be determined. So it should not be a price which is very vague or a price which is very broad. Like I gave you example in the previous class, that against this machinery he wants me to take care of his parents who are in India for next 2 years. Now this price cannot be valuated. You cannot fix some value for this, and if value cannot be fixed, your price is rejected. Then another condition is either the exporter should not ask from me any share in my further sale proceeds. So let us say whatever shirts I'm importing, now I'm going back to the shirt example. I'm purposely taking two example, one of machine, one of shirt, so that I can explain you different rules application. So now I come back to the shirts example. So why I'm importing these shirts? So that I can resell it in India. This is my business. Now, if the exporter
is keeping a condition that if you are selling these goods in India, let us say for 1,000 rupees, you have to give me some share. This is what is C condition. So first, it is saying firstly there should be no such condition of sharing with the exporter any part of the sale proceeds of subsequent resale. First condition. Second, even if such condition is there, the condition should be such for which an adjustment can be made in Rule 10. That is, the additions which we are going to study provided in Rule 10, that should be capable of being done today. Today means at the time of import. Because see, we have to determine custom value today. These goods would be sold in future. Now, if he is putting a condition that out of the sale proceeds, whatever I get, I have to give him 10% extra. Okay, firstly, this condition should not be there. But if it is there, still it is accepted. But today, we should know how much that 10% would be. So maybe he has given that he will sell it for a price of 1,000. And then I have to give 10%. So we know extra 100 will be given per share. In that case, also, it is okay. Otherwise, because of this condition where the exporter has said ki you give me some percentage of your future sale proceeds and that is not determinable today, then your transaction value, because in that case it will be incomplete today, it will not be the full consideration, which is one of our basic condition. So transaction value will be rejected. Next is, this condition appears to be repetition because it was there in the section also that the buyer seller should not be related, but it is not a repetition. In fact, this point over here relaxes this condition. So firstly, it says preference is what buyer seller should not be related. So same condition of section 14, but then it says even if they are related, we will still accept your transaction. How? For this, the next sub rule 3 gives the additional pointers. So where buyer seller are related, your transaction value can still be accepted. When or how? So in such case, the importer will have to do something additional. What? Firstly, when the custom officer is examining, he should be proven by the importer, obviously through evidences and proof, that even though you and your exporter sitting outside India are related persons, but your relationship has no influence on the transaction value. So the transaction value which he has charged to you is nominal. Normal. It is the same transaction value which he charges in the common market. That is how you can prove that your relationship has not influenced the price. Second, the importer has to further substantiate with proof, that is, he has to demonstrate what? That the declared value, that is the transaction value which the importer is declaring, even though if it is rejected because of this ground, still the value under customs, which will be determined by the other rules, will be nearing this value only. So what he has to prove, that his transaction value is very close to the value given in the other valuation rules that we are going to revise. So we had studied these rules, we are going to revise this again. So what he proves is that his value is very close to the other values that the law asks us to take. Now, if it is very close to the other value, then why reject your value? Take your value only. And last, he should not provide any substitute values in this case. So only genuine values should be given. Now we proceed with the other valuation rules. This will be required if your transaction value fails. Just a minute, please.
Now proceeding with the other rules. Now rule 3, which is transaction value of my own goods, is rejected. Now then, I have to follow the other rules in sequence. So this is what is also provided, that now if my value is rejected, now I'll have to determine the assessable value applying the other rules, but these rules have to be proceeded sequentially. Now, what does these rules say? Now, as per these rules, first value to be taken is transaction value of identical goods. I've already explained what are identical goods. They are the same Van Hussein shirt imported by some other importer in India. Now, what does rule 4 says? So, you can take the second option as the transaction value of identical goods. Again, same, it should be sold for export to India. And here they have put a condition which is imported at or about the same time when I'm importing my shirts. So the other importer also should have imported it near to my imports. Then come the next condition. The other importer who is importing this, that importer's transaction and my transaction should be same at commercial level and also at quantity level. Now it is same at commercial and quantity level. So if I am importing it as a distributor and if he is importing as a retailer, it is not same commercial level. You can understand price to distributor and price to retailer is not same. So it should be at same commercial level and in the same quantity level. If I am importing 1,000 pieces and he is importing 1 lakh pieces, maybe his price will be discounted because of higher quantity. So again, it should be in the same quantity level. Then comes the next part. In case an importer who has imported same shirts, that is identical goods, but his sale is not matching with my sale in terms of commercial level or quantity level, then the second part says you still take his sale price and you make adjustment for these differences. Which differences? Differences of commercial level and of quantity level. Obviously, to make these adjustments, I will have to give evidence, proper evidence, and through evidence, I have to establish the accuracy of these adjustments. So like the price list of the supplier only where he is giving price for 1 lakh pieces separate and 1,000 pieces for distributor level and for retailer level. If I have such demonstrated evidences, that will be accepted. Then further, the importer may have imported these goods by air. I'm importing by sea. He has imported at Kolkata port. I'm importing at Bombay port. So there could be differences in those costs. We are going to add in rule 10, which includes mainly your transport costs, freight, etc. In such cases, if his price, which is including these costs, is different. Why? Because of difference in the distance. Because I imported at Mumbai, he imported at Kolkata. Definitely there is difference of distance. Second, he imported by air, I imported by sea. So when you're taking his cost or his price and you are adopting it for my goods, you will have to make these adjustments again. So these are the adjustments for differences in the distance and means of transport. So this is how value will be derived, taking the value of identical goods. Then if let us say no importer is importing same shirts, but there are importers who are importing shirts of other brands, which are similar to my shirt, they are commercially exchangeable, interchangeable. That is what is similar goods. So now you will take those prices of those other importers who have imported similar shirts or similar goods. Now here, while adopting this rule, it says you adopt all the above conditions which you just read in rule 4. So what were those conditions? It should be at or about the same time. It should be same commercial level, same quantity level. If not, make adjustments on the basis of demonstrated evidence. Next, if there is difference in the place or the method of transport, make adjustment for that. So you have to apply rule 4, mutatis mutandis, here. Now comes rule 6. Now when rule 6 is applicable, my goods value rejected and either there is no similar or identical goods being imported or their values are also rejected for some reason. So it means our above three values are failing. Now these three were real values. Mine was real value.
other importer importing same goods that is identical was real value, some other importers importing similar goods was real value. When real value fails, the other two rules, 7 and 8, provides a mathematical approach. Now, rule 6 says, now when you are proceeding further, our mandate was you have to proceed sequentially. However, rule 6 allows the importer to request the officer that the order of the next two rules be changed. And generally, the officer will allow. So, if the officer allows, then instead of taking rule 7 value, you can take rule 8 value. That is the option given to the importer. Now, what are these two mathematical values? Rule 7 says deductive. I call it as back calculation. So, what is rule 7 saying? After import, you have to see what happens to your goods or the similar or the identical goods. So why I'm importing these shirts? Why other importers are importing these shirts? So that they can resell it in Indian market. So let us do one thing. Let us go to Indian market where these imported goods after import are being sold and take a price at which these goods are sold in Indian market in the greatest aggregate quantity to unrelated persons. So two conditions. What is greater aggregate quantity? You can understand theoretically, but I'll explain. But 1 second before that, the price which I have to take of Indian market, it should be of these goods only, that is my goods or identical to my goods or similar to my goods. And it is the Indian price where the buyer is unrelated. Because if the buyer is related there again, that price is rejectable. So it means it is the fair price, arm's length price, as we normally call in economics. Now, what is greatest aggregate quantity? Now, these shirts, when they would be sold in India, there is a possibility that we are selling to multiple persons. To some, we are selling quantity of 100. To some, we are selling quantity of 50. To some, we are selling quantity of 500. So they are saying, take the price which you charged to that person in India where you sold the highest quantity. So when I sold these 1,000 shirts in India, I am selling 500 to someone, 200 to someone, and 500 to someone. Out of this, the highest aggregate quantity is 500. So I will take that person's price. That price will be taken as the starting point. Now, that price cannot be the final answer because we have already seen in section 14 condition, you cannot take domestic prices. But this is just a mathematical approach. And anyways, we are taking price of the imported goods only. After import, what has happened? They have been resold in India. So you are taking the uh, Indian market price at which these goods only are sold. And now what you will do, you will do back calculation. What is this back calculation? You will start subtracting, you will start deducting all those things which were added post import. Now, what would have been added post import? First is the word uses commission. So basically, it covers your profit margin and the common expenses. So any businessman, what he does, he will load some share of his expenses, which we call as overheads, and plus add his profit margin on any goods which he is importing before the resale. So subtract that margin. Then obviously what he would have loaded, all the cost he has incurred post import, like transport cost, insurance cost within India, that is after landing at the Bombay port till reaching it to the market, I have incurred all these costs and I would have added it in the price, subtracted. And last, all the duties, taxes which I would have paid post importation, mainly customs duty and maybe if there are other local taxes, all those things are also included in this price, subtract. So you have to do back calculation, deductive value, correct? Now this thing you can do for the same goods, if not for the identical goods, if not for the similar goods. Now, what the sub rule says, which dates value you have to take. So you are taking Indian market price, but it should be at or about the same time as the goods being imported. But many times this may not be possible. So they have relaxed this condition saying that if it is not available, that is price at the same time, then take price earliest after its importation. And here they have given the timeline of 90 days. So immediately after importation, they are giving timeline up to 90 days. Within this period, whatever is the Indian local market price at which you have resold these goods in India, take that and do backward computation. Next, the condition is that you take the price in India only where the imported goods, etc., are sold in the same condition as imported. Means what? That there is no processing involved. They are only resold without any further processing. Obviously, why? Because once they're resold, there would be more additions in the value for processing, etc. So that could be a challenge. Then further it says, in such determination, due allowance shall be made for value added by processing and deductions provided in item. So first preference is you sell the goods in the same condition as imported, take that price. In case again that is not available, why? Because you have done some minor processing. Many times we do. So let us say after import I have done some packing because I wanted to change the tag and put my brand name, etc. So those are minor processings. If they are done, take that value and then even subtract the amount towards this minor value addition by processing, and that also has to be then deducted. So basically this is the mathematical approach of coming backward up to the price which you want at the time and place of importation. Second mathematical approach is the forward calculation. I also call it as the cost sheet method. Now under this method, what we do, we take the costing details of the foreign supplier. In the previous class only somebody asked sir whether this will be possible. Obviously it will not be possible, but one of the option given in the law, or one of the method given in the law, that is why you see the law itself has kept it as the last method. You do costing. So how you do costing? Prepare a cost sheet in which you will take the value of material, then the manufacturing cost, which we call as factory overheads, then your cost towards general expenses, which will include administration, selling, etc., and obviously the profit margin. So in short, here you are finding out the value of these imported goods by cost sheet method. So all these details you'll seek from your foreign supplier, which is impossible, but this is what the law is saying. Make addition, find out the price, and then in that add all the expenses that that person would have incurred till this point of place of import. Now coming to rule 9. Now rule 9, reading wise, appears to be simple, straightforward. Practically, it is a very difficult rule. What does rule 9 says? The rule 9 says the value of imported goods, if cannot be determinable under any of the above methods. Now all above methods are specific method. Why specific? They are giving you exactly how to compute. So it says if that is not possible, then you will determine the value using reasonable means consistent with the general provisions of these rules and on the basis of data available. So now here, no method, no mechanism is provided. It is said that you go back to above rules, see what are the principles. So what are the principles? The principles are it should be international price. Principle are it should be at the time and place of importation. So those are the principles, those are the guiding lines. Use those principles which you have got in the above provisions, that is section 14 and the rules, and applying those principles, you determine the value. This is what theoretically the rule says. Now let me explain you practically what happens. See, practically in this rule, I go back to the above rules only. Now, what has happened? Actually, my goods price is there, but you are rejecting for some reason. You went to identical goods, you found identical goods. But again, some of the conditions that it is not imported at the same time, it is having some different shape size. Because of that, you rejected. Then you went to similar goods. There were similar goods also. But again, you rejected the similar goods value also for some other reason. Now, you were very strict at that time because you had multiple options in the form of many rules. Now, when you have exhausted all these options and you come to rule 9, what it says, go back. Now, go back to the above rules. You already had some value in the above rules which you rejected. Now we will take those values and we will just do some minor correction, or we can say adjustment, so that whatever were the reasons why we rejected the value, that could be nullified and we could derive some value here. So practically here, how the value is determined, you go back to the above rules, whatever values were available in the above rules, you take that value, make some minor adjustments to correct those differences because of which you had originally rejected the value, and you try to derive a value which is near to the requirement. Why I'm saying near to the requirement? Because it is not precisely matching my requirement, but by making some, what we normally use the word jugad, by making some jugad, by making some adjustments in the value available, we reach to our final answer. However, this rule has strictly said that certain things cannot be done in this rule. What? You cannot take the selling price of the goods in India. Second, you cannot take the price which provide for accepting the higher of alternative value. So now let us say when you go back to above rules, you will find value available in multiple of above rules. Now you cannot take the highest of those values. That is not allowed. Next, you cannot take the domestic price of these goods in the country of exportation. Similarly, you cannot take the price, domestic price of the goods in India. That could be the starting point to reach back, but that cannot be the final answer. Then the cost of production other than the computed values cannot be taken. So when you are doing a costing approach, take it value strictly as per it, no other additions. Then you cannot take the price at which these goods are sold to some other country. So let us say we'll say, okay, our Indian prices are not available or acceptable, but these goods are also exported to Bangladesh, also exported to China, also exported to Japan. Let us take those prices. No, that is not allowed. Next, again, you cannot take minimum of the custom values here, and you cannot take arbitrary or fictitious value. This is what is not allowed. I hope it is clear. If anybody has any questions, doubts, please feel free to ask before we proceed. Students, if anybody, any questions or doubts, please call. Let me know what are your doubts. No? Okay. Now I come to the most important rule. What is this rule? Now in this rule, you are required to make some compulsory additions in the transaction value. Now, firstly, what is the logic? The logic is simple. We want a price, we want a value at the time and place of importation. To ensure that your transaction value matches this criteria, Rule 10 has provided some additions. Now, what are these additions? These additions are towards those expenses cost which are incurred prior to this time and place of importation, but are not forming part of the transaction value. Now, somebody will ask, sir, when this will happen that some price or some cost is incurred, but it is not part of the transaction value. I'll tell you the situation. The situation is where some of these costs are incurred by the buyer, that is the importer. Now, this is logical. If any part of cost is made by the buyer, so it is terms of the contract that I will arrange the transport. It is terms of the contract I will arrange the something designing, etc. So if some part of the work or some part of any expenses up to this point, see, our main critical point is we want price at the time and place of importation. Prior to this, whatever things are done, as per contract, something may be done by me. In this case, the value or the cost of such things done, that is the expenses incurred by the buyer for any of these things, has to be added. This is what Rule 10 says. Now, Rule 10.1 covers a list of expenses that are incurred. relating to the processing, manufacturing, making of the product. Rule 10.2 deals with the costs that are incurred for transportation, insurance, for bringing the goods up to the place of importation. So 10.2 is mainly the transportation cost, the logistics cost. 10.1 is the cost which is incurred in the entire manufacturing activity. Now, what are these? Let us understand. Sanjay, are you available to read? Or Prithviraj? Anybody can help reading?
Yes, sir.
Please.
Am I audible, sir?
You are audible. Please go ahead.
Okay, sir. The following, to the extent they are incurred by the buyer but are not included in the price, actually paid or payable for the imported goods, namely
So,
commissions
firstly,
and brokerage.
what has to be included? Following costs will be included. And as I said, why they are included? Because they are incurred by the importer, incurred by the buyer. That is why the transaction value is not including them. So that is what is clarified. To the extent they are incurred by the buyer and they are not included in the transaction value. So price paid or payable is your transaction value. So where I have incurred some cost, but they are not part of the transaction value, they have to be included. Now let us read the list and we'll try to understand each of these items. Yes. So you first read these three items, then I'll explain each of them. Yes, Prithviraj.
Namely commissions and brokerage, except buying commissions. The cost of containers, which are treated as being one for customs purposes with the goods in question. The cost of packing, whether for labor or materials.
Now, what is the first clause A providing? It is providing for adding three expenses. I'll first come to the second and third, which are simple. Cost given in subclause 2 is the cost of containers, and subclause 3 is the packing cost. Now, if let us say you are the manufacturer, whatever packing is required, that is either done by me or I'm providing you the packing material and all. Second, these goods have to be stuffed in some containers. So when you are sending it for import or international trade, or you can say these are like the packaging cost. And what is condition given, which are treated as being one for custom purposes with the goods in question, which means what? That these are non-returnable. See, one is returnable packaging. Obviously, that should not be added because the packaging would be returned. But where the containers would be retained by me, so obviously this is also a cost. Now, if this cost is incurred by me, it has to be included. Fine. Now comes the most important one. Not important one because it is compulsorily given in the exam question, but because it has confusion. Now, what is the confusion? The law says you have to add what? Commission brokerage. Then it says except buying commission. This is where the confusion is. Why the confusion? Because as an importer, what am I incurring? If I'm incurring a commission, obviously it has to be buying commission because importer is the buyer in the transaction. Now, if importer has incurred a commission, brokerage, you say it should be added, but then you are accepting the buying commission. So what is this? So when we go to the interpretative rules in 13, the interpretative rules in 13 have given explanation relating to this point. What does the rule say? The interpretative rule 13 says that buying commission means what? Firstly, what is included? Let me tell you. So I am the importer. Now, many times in international trade, you have agents in between because the foreigner is not believing on me. How can he send the machinery without me making the payment? And I will not make prepayment because again, I am not having the belief that if I make the payment, he will make actually the delivery of correct goods. So many times in international trade, there is always a person in between who acts as a liaison between me and the supplier so that we both can comfortably complete the transaction. And definitely, this person for doing this work will charge a commission. Like in any other business transaction, where you are having an agent in between, a broker in between, for helping you do that transaction, you pay the commission. Now, If importer has kept such type of a person, his commission which he is charging on the basis of goods imported. So normally how they charge, any broker will charge what? Ki how much goods you have imported? You have imported 1,000 shirts and it is valuing, let us say, 1 lakh rupees. He will say, okay, pay me 2% commission of this 1 lakh. The commission which I am paying to the agent who is helping me do this import is to be added. Importantly, in exam questions, many times this commission is given in rupees. Again, students have question, ki sir, all other figures are given in dollars or euros. Only this figure is given in rupees. So should we add? Answer is yes. See, there is no exception here that the payment to be added should only be in foreign currency. If any of these costs are in rupees, you have to add it. Now, what is not to be added? What is this buying commission which is not to be added? Firstly, let me tell you, in exam sums, all the buying commissions which are given are the ones which are to be added. This is only as a, you can say, academic point or theoretical point. In case you have to write some theory answer, you have to write this exception. But what is this buying commission in reality which is not to be added? This is also, as I said, explained in Rule 13, that is interpretative notes. What it says, I'll give you example to understand what is this buying commission not to be added. Now, first was the commission which I am paying to the agent who is helping me do this import. And generally the payment of this commission is in a percentage. So it is linked with how much I am importing. So every time I import, I have to pay him commission, that is included. Second type of agent is, now I do not know from where to buy these shirts, or in my other example, where or from whom to buy the machine. So I know my specification, I know the machine which I want, but I do not know who is the right person in Germany making that machine. So I contact a technical expert in Germany and I give him the mandate that, see boss, this is the machine which I'm looking for. These are the machine specifications. You have to identify a seller of this machine from whom I can buy this machine. Same is, let us say, with the shirts example also. Now, this person is generally a person sitting outside India who is helping me to identify the supplier, identify the seller or manufacturer of that machine, and to strike a deal with that person. So this particular agent or this particular person's role is slightly different than regular agents. This person will be required only once, not every time I'm importing. Once for what? For helping me identify the person, the seller, the supplier, the manufacturer outside India. He will locate 2-3 persons. He will get their quotations. He will give it to me. I will check. I will check the quality. If required, if possible, I'll get some samples, some demo. And this person will help me finalize the supplier. Now, generally, the commission which I pay to this person is fixed lump sum. Why? Because it is one time. Because this person's role will end once he has given me the seller supplier. Then, once I have identified the supplier, he is out of picture. Then, every time I have to import, I will not require him because his role was limited only to identifying the manufacturer or supplier. The commission to him is a fixed amount generally because it is not linked to how much I'm importing. His role is over with helping me locate the right person. This is what is the buying commission they are saying not to be added. Practically in exam questions, this buying commission is never given. They always give you the first commission which is to be added, which is given to the agent who generally charges commission in percentage, because every time I import, I will be requiring him because he will be the licensing person between me and the supplier. And because of his efforts, my every import will materialize. So he will be paid commission every time. His commission or brokerage will be generally in percentage, maybe in foreign currency, maybe in Indian currency. That makes no difference. That is to be added. So students, I hope you understood this, because this is the point which is the only, I believe, in this whole rule 10, the point which creates confusion to the students. Yes, there are some more technical points, but this one generally creates the confusion. How? Now Sanjay has a very valid question. Are payments to CHA agents added? Answer is no. See, why no? Because the CHA agent is what? Is he the agent helping you do the import? I don't believe so. In fact, CHA agent's role is post importation. His role is doing all the procedural work at the port, helping you clear the goods. So, in fact, CHA agent, though he is also called as agent rightly, as you have pointed out, CHA agent is the agent who is doing the procedural part after import for complying with the custom laws. So he is not the one who is helping me import. So CHA agent commission is never included. Fine. Now comes B. Now what is B? I'll first explain, then you read. So B is whenever any raw material, any consumable, any spare part, any tools, dies, which are required in manufacturing this final product. So I go back to the example of machine. Now for making a machine, there are many small and big parts, assemblies, tools which are required. Now many times what happens in international trade, I want machinery to be made by a particular manufacturer sitting in Germany, but something in the machinery, maybe some part, maybe some, let us say, a blade required in the machine, or maybe the machine spare part is supplied by me only. So I am only sending him the machine uh, parts which he would be using in making the final machine. So if I am from here sending him anything which he will be using in making the machine, obviously I do not charge it because that machine is for my purpose only. So many times you'll find that people, even domestically, they get goods manufactured from someone, but they themselves provide the required inputs, material, consumables, etc. In such cases, obviously the seller will not include that amount in his price because he has not incurred the cost. But the law says if machinery is imported into India, I want to charge tax on the full value or full price of machinery. So if any part of this machinery value is borne by the importer because he has provided those parts, goods, etc., and hence it is not part of the price, let us add it. That is what is clause B. Please read.
The value apportioned as appropriate of the following goods services were supplied directly or indirectly by the buyer free of charge or at reduced cost for use in connection with the production and sale for export of imported goods to the extent that such value has not been included in the price actually paid or payable, namely materials, components, parts, and similar items incorporated in the imported goods, tools, dies, molds, and similar items used in the production of imported goods, materials consumed in the production of the imported goods, engineering, development, artwork, design work, and plans and sketches undertaken elsewhere than in India and necessary for the production of the imported goods.
As the rule says, you have to take the value. If required, you have to apportion. Now, why this word apportion is used? Because many times things like stools and dies, let us say I'm sending you the die, which you have to use in making my goods. Now, a die may be used for making 1 lakh pieces. Today, you are only sending me 1,000 pieces. So, in such cases, where the item which I have sent to you is going to be used for a lot number of items, then in such cases, we have to take apportion value. So the value of whatever goods, services which I have sent to you free of charge or at a concessional price. Why? Because it will be used in my goods and again coming back to me, and which is for being used in connection with the goods which you are going to produce and sell to me, has to be included. To what extent? To the extent such value is already not part of the price. Now, what will be this? Raw material components, tools, dies, consumables. Now, for all this, there is no restriction condition. But if, let us say, I am sending the manufacturer the basic design work. See, many times you all know that for any engineering goods, firstly, a blueprint is made, a technical design is made, and on the basis of that technical design blueprint, the production happens. Well, let us say this designing is also done by me. In fact, many times it would be, because you are only the manufacturer who is going to do manufacturing. But what exact shape, size, specification required, I will get it designed and send it to you. Now, in such cases where I am getting it designed and I'm sending it to you, in such cases, that also has to be added. But here there is a small condition. The condition is that the design which I'm sending it to you, the artwork, is not done in India. So if I have got this design made from India and sending it to you, then it is not to be included. But if this design got made in Japan, or I got this design made from a technical expert in Russia, and I'm sending that to you, the cost of that design or artwork or engineering plans will be included. Now, just to know the logic, see, the logic is what? If something originally belongs to India, like here the designing part, why to again pay duty on that? Because that is what is given outside and that is what is coming back. So hence that is not to be included. So when it comes to design work artwork, we will not include the price or value of that design work artwork which is done in India and sent to you. Now, besides this, what are the other costs that has to be added? So many times the goods are having some brand for which royalties are applicable or some license fees is applicable, and that is paid by me. That has to be added. Next, if let us say this was one of the conditions above, you have contracted with me that the shirts which you are sending to me, I have to sell in India, let us say at 1,000 rupees, and further give it to you 10% in future whenever I sell. So whatever I am going to give you out of my future sale proceeds, that is to be added. And then a generic point, any other payment which I have made on your behalf. So it was your cost, but I have made, that has to be added. Please read in detail all these points. CDE.
The royalties and license fees related to the imported goods that the buyer is required to pay directly or indirectly as a condition of the sale of the goods being valued to the extent that such royalties and fees are not included in the price actually paid or payable. D. The value of any part of the proceeds of any subsequent resale, disposal, or use of the imported goods that accrues directly or indirectly to the seller. All other payments actually made or to be made as a condition of sale of the imported goods by the buyer to the seller or by the buyer to a third party to satisfy an obligation of the seller to the extent that such payments are not included in the price actually paid or payable.
It is simple, I think CDE. Go ahead with the explanation.
Explanation: where the royalty, license fee, or any other payment for a process, whether patented or otherwise, is included referred to in clauses C and E, such charges shall be added to the price actually paid or payable for the imported goods, notwithstanding the fact that such goods may be subjected to the said process after importation of such goods.
So what is this? So let us say there is some process to be done on these goods, and that process is a patented process. Now, we have already asked here in clause C to add that point, or in E, which is generic, that any other expense which I am meeting has to be added. So the question is, if such charges, like I'll read from here, such charges shall be added to the price paid payable for imported goods, notwithstanding the fact that such goods may be subjected to the said process after importation. So interestingly, any of these processes are done after their import in India, still it will be included. Now this is interesting. Why the law is asking us to include this? Reason is, I'll give you an example. Let us say we are talking about uh, burger. I forgot the name. What is MACD? Now we all know McDonald's is a foreign brand. It is a US brand. Now let us say the terms and conditions are such that these goods which are imported have to undergo, let us say, some heating process, obviously, which will be done here only. And this heating process is the patented process of McDonald's. So whatever is done, there is some component of license fee royalty which has to go to McDonald's. Now, obviously, the heating is done here. The final preparation activity is done here. But if this is the patented process for which the royalty will go to the foreign supplier. So even though this is done after its importation in India, but that is very much part of the completion of the goods, because without this heating or preparation, the final burger will not be completed. And obviously it cannot be done by the exporter and sent, because that will be of no use. So there are many times, I'm just giving you a very common man example to explain you what it actually means. Practically it is not for burgers and all, it is for many manufactured goods. Like, I'll tell you what it is practically. So let us say this machine which I have imported from Germany requires technical support for its installation. And this technician will also come from Germany, because it is not a simple regular machine which can be installed and commissioned. So it requires again maybe 2-3 months for its proper installation. And for this, I require a person coming from Germany only. Now, until and unless this machinery is workable, the final work of the complete work of the supplier of machine is not completed. But this installation commissioning will be happening in India. This is what is covered here. So where any of these payments are with respect to these goods, where the work, the last part is completed in India, that will also be includable. Now we come to the most important part, because this will be required in every question. What is this? Sub-rule 2 requires you to add transport related cost. So basically it requires you to add two costs: the freight cost, which is for transportation, and the transit insurance. In all international trade, every time the goods are insured while they are transported, because they are coming from sea majorly, so there can be some mishap. Nowadays, you'll see that because of all this international tension between various countries, there are some rebels in the sea who are purposefully destroying ships or putting a particular ship on fire. So there could be such incidents, because of which in international trade there are risks associated to transport. So you also get the insurance done. Now, again coming back to the logic of this, we want the price of these goods at the time and place of importation, which is the Bombay port where these goods are landing from, where they will be cleared. Now, if the transport insurance is my responsibility, who am I? The importer. Because the exporter has given the price FOB. FOB is free on board. That is the price up to which he will bring and load the machinery on ship at the German port. His role is over. So his price is only up to there. Then for bringing the goods to India, I will require transportation and I will require insurance. This transport insurance, which is incurred by me, which is 90% cases incurred by the importer, has to be added. And this, firstly, the rule says add the actual transport. Then the rule says in case the actual transport or actual insurance is not includable, what is the amount that has to be added, because this addition is compulsory. So even if it is not given in the sum, you'll have to do it, because the law has provided for a percentage. And then in case of air transport, they have also provided a limit. So in case of air transport, the amount to be added will not exceed the amount as per the limit. Please read.
For the purposes of subsection 1 of section 14 of the Customs Act 1962 and these rules, the value of imported goods shall be the value of such goods and shall include the cost of transport, loading, unloading, and handling charges associated with the delivery of the imported goods to the place of importation, the cost of insurance to the place of importation.
So two things to be added: delivery charges and the insurance. Go ahead.
However, where the cost referred in clause A is not ascertainable, such cost shall be 20% of the free on board value of the goods.
So what is the assumed amount which you have to keep in mind? So even if in the exam some freight cost is not given, whatever is the FOB, you have to add 20% of FOB towards freight. Go ahead.
Further that where the free on board value of the goods is not ascertainable, but the sum of free on board value of the goods and cost referred to in clause B is ascertainable, the cost referred to in clause A shall be 20% of such sum.
So let us say what they are saying. Free on board value is not given in the sum, but free on board, including insurance, is given. Okay, on that you add 20%. Proceed.
Where the cost referred to in clause B is not ascertainable, such cost shall be 1.125% of free on board value of the goods.
So for insurance, the assumed percentage again, which you have to keep in mind, is 1.125% on free on board. And again, here the next para says where free on board plus freight is available. Independently, free on board is not available, but free on board plus freight is available. So 1.125% will be calculated on this total. Proceed.
Where the free on board value of the goods is not ascertainable, but the sum of free on board value of the goods and the cost referred to in clause A is ascertainable, the cost referred to in clause B shall be 1.125% of such sum.
Now comes a restriction on the maximum freight cost for air. Please read.
In the case of goods imported by air, where the cost referred to in clause A is ascertainable, such cost shall not exceed 20% of free on board value of the goods.
Important. So when in the question you are given air freight, even though it is given, before adding, you'll have to confirm if that free on board is up to 20%. That freight cost is up to 20% of free on board. If the freight is exceeding 20% of free on board, you will take only the amount which is 20%. So for air only, not for sea or land, for air transport only, they have kept a maximum limit up to which the freight cost can be added. Proceed.
In the case of goods imported by sea or air and transshipped to another customs station in India, the cost of insurance, transport, loading, unloading, handling charges associated with such transshipment shall be excluded.
Very important. Now, many times in the sum, they will give you these transport costs also. What is that? Where it is imported and it is transshipped to another custom station. Now, what is transshipment? I'd explain. So my ship is coming to Bombay port, but it is carrying goods up to Kolkata port, up to Madras port. So in the same ship, the goods will go further, first possibility. But many times this does not happen because the ship will not go to my other Indian ports. It will unload all goods at Bombay port, and then the CHA will arrange the transport of goods from Bombay port to the other ports. Now, in this particular case, this second transport is what is called as transshipment. Now, when the goods are transshipped from this Bombay port to other custom stations in India, whatever cost you have incurred for its insurance, transport, loading, unloading will not be added. So be clear, this transport cost is not to be added. Further, the transport of imported goods referred to in A includes, now this is to be added, what? Ship demurrage charges of chartered vessels or litterage or bar charges. So if these expenses are given in the question, you will add this. So this will be part of your input cost, right? Then 11 is importer has to give declaration that all details which he is providing is true and there is nothing which he is trying to conceal or provide false information. And despite of that, the officer is empowered to reject. However, why the officer is empowered to reject? Because if the officer doubts about the truth and accuracy either of the value or of the other details which are provided, because we need many adjustments to be done, as you are seeing. In fact, even rule 10 requires many things to be added. Who will provide the details? Importer only. So even if the officer doubts the truth accuracy of any of these adjustments, he may reject your transaction value. However, at the request of the importer, the officer shall intimate the importer in writing the grounds. Okay, on what basis he is doubting, why this is done, so that if required, the importer may go in for appeal, and on the basis of the reasons for doubt, he may get his value restored. So why the officer will have doubt? The reasons for his doubts are given. Please read this.
The proper officer shall have the powers to raise doubts on the truth or accuracy of the declared value based on certain reasons, which may include the significantly higher value at which identical or similar goods imported at or about the same time in comparable quantities in a comparable commercial transaction were assessed.
So in case
Thus,
the officer knows that similar identical goods are imported at much higher value than what you are shown, obviously this is the reason for doubt. So here the law has provided what could be the valid reasons for doubt. So first reason, similar goods are imported at much higher price. Second,
the sale involves an abnormal discount or abnormal reduction from the ordinary competitive price.
next,
The sale invoice involves special discounts limited to exclusive agents.
next,
The misdeclaration of goods in parameters such as description, quality, quantity, country of origin, year of manufacture or production.
so there is
The
some problem
non-declaration
in the declaration which is given and there is some confusion. So he doubts because you are then trying to hide like the country of origin. You are saying something, but it appears something else. Or year of manufacture, you are trying to show that it is manufactured 6 months back so that you can take the benefit of lower price, but it appears to be very recently manufactured. So these are the other reasons. Next,
The non-declaration of parameters such as brand, grade, specifications that have relevance to value, the fraudulent or manipulated documents.
so these are the reasons. And you have to see, you have to read Rule 12 more from theory point, and especially in Rule 12, this part you have to learn. And then comes the last interpretative notes, which we studied in the previous class, also relevant to our starting rules. Hmm. Now, some other interpretative rules. So, for the purpose of Rule 7, the earliest date shall be the date by which the sale of imported goods of identical or similar goods are made in sufficient quantity to establish the unit price. So, Rule 7, which is the deductive value, requires you to take the price which is nearest or earliest to your date. So, what this earliest means? The price which is available after these goods are sold in India. Where the method in 7.3 is used, deductions made for value added by further processing shall be based on objective and quantifiable data. So if by chance you are having some minor processing done, that will be subtracted, but for that, again, you should have objective data. Then notes to Rule 8, here costing is to be done. And in costing, again, you require the data from the producer of these goods, and the data should be provided on the basis of the accepted accounting principles. So what it means, like for depreciation. So what rate of depreciation should be taken? What method of depreciation should be taken? Then many times some expenses are taken on accrual basis. Some expenses are taken on the basis of assumptive figures. So wherever any of these cost or values are taken, they have to follow the generally accepted accounting principles. How will you determine the profit margin? So for this, they say that we will take the profit margin which is applicable to goods of same class or kind. So now for such things, they are using this terminology, same class of or kind means what is the general profit margin of the goods in that industry, right? That will be taken. That's it. And then rule 9, which is the last rule, which again reiterates the same thing. In this rule, you have to follow the previous rules only, take their values only, and make some changes, like what it is saying, some flexibility in those rules so that those value which you originally rejected would now be accepted. That is what is rule 30. Now for rule 10, the buying commission, I already explained what this buying commission is, which has to be not added. It is the fees paid by the importer to the agent who is representing him abroad. So as I said, now he is that agent who is only helping you to identify the supplier. So this is one-time payment. That is why they are purposefully using the word fee, because many times it is not as a percentage. And then relating to the additions for cost. So they have tried to clarify how you will do those additions. So these things are provided in the explanatory notes. You are not supposed to learn them, but definitely just go through them once for the purpose of your clarity and for the purpose of your understanding. I've already taken the important rules which are required. Mm. Now I think I'll take some practical sums. So if after taking these sums, if time is left, I'll come back to these rules. Otherwise, we'll go to these sums so that you'll get more better clarity about this topic. So now it is around 9. We'll take a 15 minutes break. I'll have some breakfast, you also have. And then we'll connect for dealing with the practical part of this chapter. Fine? 15 minutes break.
serious, which only I have to attend to. So I'm sorry for the time gaps. What is this document? Okay. Fine. So now let me take you through some practical examples so that you better understand the provisions what we discussed. Now, let me take up the example first so that when we read the question, the understanding of the answer will be much easier. Fine. Now, what is given? Material was imported by air at CIF. Now, we have to be very careful with the detailings given. CIF price is 5,000 US dollars. Freight 1,500 US dollars. When you're reading freight, always focus on whether it is air freight. Because if it is air freight, you will have that limit of 20%. Insurance cost 500. The banker realized the payment from the importer at the exchange rate of ₹71 per dollar. Central Board of Direct Taxes Customs notified the rate as 70. Now again we know we have to take whose rate. This we studied in section 14 that for exchange rate we take the rate given by CBIC. So CBIC's rate is 70 per dollar. Find the value of the material for the purpose of levy. Now, we are given CIF value, but we go back just for our purposes to the FOB value because this may be required one if the freight is air freight so that you can take maximum 20%. So how will derive FOB value? So if CIF value is given, CIF means FOB plus insurance plus freight. So when you subtract both these things, you reach back to FOB value. So 5,000 is the CIF given minus freight minus insurance which is given, you reach to FOB value. Now, in this FOB value, since the travel or the transport is by air, hence we have a limitation of adding maximum 20% of FOB towards freight. So 5,000 CIF minus this, I reach 3,000. So on this 3,000, 20% is the amount maximum, which comes to 600 plus insurance, which will remain actual. So I get CIF for custom purposes and then multiplying it by exchange rate, I derive the value. I hope this is clear. Please see. Now, since this is clear, we proceed to the next point or the next case. So from the particulars given below, find out the assessable value of imported goods. Now again, step by step, be clear. So we are adding with every question some more adjustments. Now what is this question saying? Cost of machine at the factory of exporter. So be clear what the values are representing. So this is the value at the factory of the exporter. So this is still not your value. It is the value at the exporter's factory. Now, transport charges from the factory of exporter to the port of shipment. So this is still the transport in his country and it is all before place of importation. So we know it has to be added. Then comes the next part. What is the next part? You have handling charges for loading the machine in the ship. Again, this is at his end. After that, you have the third expense, which is the buying commission. Now here, if they are themselves mentioning this as buying commission, so we will definitely consider this as buying commission, which is not to be added. Correct? So you have buying commission, which is not to be added. So this is the same buying commission, which we can always presume. In case wherever you have any doubt on any of the points, you should always specify that in the answer as your note. So what is given here further? Buying commission, freight charges.
Now again, when it comes to freight, you have to go back and check whether it is air freight. So is there anything given about freight, whether it is air or sea? I cannot find so. So we are again going by the presumption it is sea freight. Now, I have to determine firstly in this question the FOB value. So how it will start? I'll take the cost of machine. To that, I will add all expenses incurred till the goods are loaded on the ship, which is FOB. So what is FOB? Free on board, that is up to loading on the ship or the aircraft in the country of export. So that comes to 10,550. Freight, as it is, we will add. Why? Because here it is not given air freight. So we always presume, because majority of transport happens through sea only. So if nothing is given, you can always take it as sea freight. Now, interestingly, in this question, if you go back to the question, they have purposefully not given insurance charges. Rather, they have given a point saying that actual insurance charges are not ascertainable. Point is, we just read rule 10.2, which says that these two costs are compulsory. Cost given in 10.1, commission, packing, etc., will be added only if a data is there. But in this case, you will compulsorily always add freight and insurance. Now, since insurance is not given, we have read in rule 10.2, it has to be taken as 1.125% of this. So we'll take 1.125% of 10,550, which approximately comes to this amount. This is your final CIF. Again, we take the exchange rate of CBIC, which given is 70. We multiply it and we get our assessable value. So in this, we went a step further. We added few more pointers. Is this clear? Any questions or doubts on this? Please confirm. Super. Now we add more adjustments. We make our work more technical. Now, what it says, compute export duty. Okay, I'll just skip export duty for the time being because it is a replica of import, but not much adjustments are there. Let me come back to import. Now, what is given? A consignment of 800 metric tons of edible oil of Malaysian origin was imported by a charitable organization in India for free distribution to below poverty line citizens in backward area under the scheme designed by the Food and Agriculture Organization. This being a special transaction, a nominal price was charged. Now, this itself, you can understand, this would be the basis for the custom officer to reject your price. So, by default, he will be rejecting your price on the So this being a special transaction, nominal price is charged for the consignment to cover freight and insurance. So actually they have not charged any price. The price, whatever is charged, is only for transport and insurance. Now, the custom house found out that at or about the time of importation of this gift consignment, following similar imports happened. Now, what are these imports? In quantity 20, 100, 500, 900, 400, 780. The rate of exchange on the relevant date was this. The rate of basic custom duty was this. And for the time being, they're asking us to ignore GST component. So calculate only the duty which is of customs, ignoring GST. Again, they themselves are saying make appropriate assumptions wherever required and give your explanation. Now, in the given case, 10 per metric ton has been paid only towards freight insurance. So it means there is no amount for goods, as I said. So now, by default, there is no transaction value and we have to go to valuation rules. Now, what are the valuation rules? Identical, similar. So we have identical goods. Now, when we talk about identical goods, there is rule 4. Now, what does rule 4 says? Provide that subject to the provisions of 3, the value of imported goods shall be the transaction value of identical goods sold for export to India and imported at or about the same time as the goods being valued. So the timing of import should be same. Fine. In the 6 imports given during the relevant time, the goods are identical in the description and of the same country of origin. So our first test of being identical is satisfied. Further,
Clause B of Rule 1 of the said rules require that the comparable import should be at the same commercial level, substantially the same quantity level. Since nothing is known about our commercial level, that is how much we have imported, that is not given. So we assume that all are at the same commercial level. Now comes the quantity. As far as quantities are concerned, the consignment of 20 and 100 metric tons cannot be considered to be of the same quantity. Why? Because our quantity is much higher. So remaining four consignments are left for our consideration. However, unit prices in these four consignments are different. Now, what does Rule 4.3 says? That in applying Rule 4 of the said rules, if more than one transaction value is found, you will take lowest of the value. So this is how we finally reach to our answer. And so the value which we are taking of similar or identical goods, in this case identical goods, will be the lowest of the four possible values that are available. And now on this basis, we proceed with our computation. So our import is of 800 tons, 800 metric tons multiplied by the lowest of the value, you get the amount. Now this amount is converted into Indian rupees. Now, since this was already CIF, so now no need to add insurance freight. Why? Because it is already CIF. And to this, we add the 10% basic custom duty. And if you remember, we had studied there is 10% social welfare charge on the basic custom duty. So that is also to be added. Yes, Sanjay, I agree to that. Key that 400 and 500 are also not at the same quantity level, right? But see, every person has its own interpretation. So the person who has derived the answer for this may have found that it is more comparable. Yes, I agree. I would have also preferred 900 and 780 only. So you are right. For me, more closer or more comparable quantity level will be 900 and 780. In fact, even more is 780 closest. But see what happens, Sanjay, as I mentioned at the start, customs is not so straightforward valuation. So in customs, when they say same, same does not means exactly same. Means even 900 is comparable and even say 780 is comparable. Why I'll tell you, because see, many times, even though mathematically we will say 780 seems to be more closer, but this is not how custom sees. See, custom wants to take the most fair value. Now it may happen that a better value is available at 900 because the proper import has happened at 900. So that is why I will say that yes, I also agree with you that even 500, 400 I will not consider. But while I'm deriving the answer, I'll compare it to 900 and 780. And out of that, applying rule 4, whichever is having the lowest per unit price, that I will adopt. Perfect, Sanjay. So it means now you are completely into the flow of the rules, and now it is completely clear in your head because the way you have presented this point argument, it shows that you are very thoroughly clear with the point. Let us proceed with the next example. Now, this example has now even more some interesting adjustments. So what it says, Foreign Trade International has imported a machine from England. It provides following details. What is that? Price of the machine, air freight. Again, as air comes, you have to keep it marked that boss, this will be tested for the 20% limit. Correct? Now, design development charges. Now, whenever you read design development charges, remember the exception that we have to add this except if it is done in India. Fortunately, they are saying it is done in UK. It means it can be added. Commission payable to local agent of exporter at 2% of the price in Indian rupees. So this commission will be also added because it is commission which we are paying for our import. And then you are given the date of bill of entry, the date of arrival. Why? This is to determine the correct rate of duty. IGST rate is given. Insurance charges details are not available. Again, we know what is to be done. So now let us understand this. So price of machine done. Design development charges done outside India. We discussed it has to be added. If this would have been given as India, we would not have added. Now, since the other expense, that is the agent commission, is given in Indian rupees, before we add it, we'll have to bring things at the same level. So this amount, which is in pounds, I will convert it applying the exchange rate. Now, which exchange rate we have to apply? Now, here, these dates are very important. Now, please remember, this is where the confusion happens. We are having two different rates. One is rate of custom duty and one is the rate of exchange. For rate of custom duty, the rule is you have to take whichever is earlier, bill of entry, arrival, whichever is earlier. But this is not the rate of duty that we are determining. We are right now determining, no, Sanjay, no, whichever is earlier, later. No. For rate of exchange, you have to only take one rate, which is the rate of bill of entry date. So for exchange, section 14 says only one rate. Correct? Sanjay? Yes. So here no earlier, later. For rate of exchange, it is only one rate. That is the date of bill of entry. For duty, whichever is earlier, that is later point. So now we have to convert. Now bill of entry date rate is notified by CBIC 100 per pound. So we take this rate. Now, so 8,500 into 100 gives me 850. Now I add the 2% commission, which I have to pay to the, okay. But then if you are saying for rate of duty, Sanjay, then whether it is later or earlier, okay, let me proceed. So we add the commission. Again, the commission was 2% of FOB. So multiplied by the conversion rate. Now I get the final FOB for custom purposes, which includes all the expenses. Now we have to add air freight, for which again the limit of 20% applies. So on this FOB, which I have determined, I'll compute 20%. It comes to this amount, and I will compare it with the actual freight cost. Whichever is lower is to be taken. Now comes the final answer, that is CIF. Now CIF is already in rupees, so no need of conversion. But again, for insurance, you all remember that if insurance is not given, you have to take it compulsorily at 1.125%. Now comes the basic custom duty, the surcharge, integrated tax, etc. Now, again, when we are talking about the rate of duty may change. Now, which is the date? Yes, Sanjay, rightly pointed out by you. For rate of duty, you have to take whichever is later. You are correct. So out of both these dates, whichever later date is the date of bill of entry. So what is the rate on bill of entry date? It is 10%. So 10% of the assessable value plus whatever is this custom duty, you have to take further 10% of that towards social welfare surcharge. Now we have to add the three values. That is your assessable value plus basic custom duty plus social welfare surcharge. This gives you the total on which you will apply the IGST rate. If you remember, we studied this in detail when we were studying the topic of types of duties. So in that, even this calculation was covered. Is this clear, Sanjay? Because this is the most complete sum according to me, covering all aspects. Super. Fine. I think on that basis now, this is now repetition. Again, you go back to the basic type of sum. So that sum which we did last is the main conclusive sum. Now here, I'll complete this chapter by now completing the last part which is left. That is, no, section 15 we already studied. It was there already in the previous chapter. I will cover the export valuation rules, which is the last part. Yes. So we studied import valuation rules. We did the questions. Now we come to export valuation rules. Export valuation is on the lines of import valuation, and it is much concise and simple for the simple reason that anyways in case of export, hardly there are very few limited goods on which today there is export duty. Hence, these rules are very sparsely used. Now, what are the rules? Again, rule 2 definition. Rule 3, which says that you take your transaction value only. Rule 4, now here you do not have detailed rule, so they do not have the rule of uh, identical goods, similar goods. They have merged it in one rule, which is rule 4, determination of export value by comparison. In comparison, obviously, you'll compare with what? Identical, similar. Importantly, they have not taken the deductive value here. Why? Because how deductive value will be applied in case of export? In foreign country, at what price the foreign importer has sold, that price minus the foreign importer's margin and all, which will be very difficult. So they have not taken the deductive value. You have only computed value. Now here, in case of export, computed value is more appropriate because the exporter is in India. The custom authority can always get the actual costing details of the exporter, which can be also cross-verified by taking a cost audit report of that, and the value can be computed. And then you have the residual method, which is similar. And then the other two things, declaration by exporter and rejection. Again, similar definition, goods of like kind, transaction value, related person, same definition. Now again, the first value says subject to rule 8, that is subject to rejection by the officer, the value shall be the transaction value. It will be accepted even where buyer and seller are related, provided that relationship does not influence the price. And if the value cannot be determined as per this rule, it will be determined by the other rules proceeded sequentially. So it is so simple. All the other complications of import valuation are not here. Then we go to the next rule. If your transaction value of your goods is rejected. Now what you will do? You will take value of identical similar. Here they have merged the rule. So they have said value by comparison. What it says? The value of export goods shall be based on transaction value of goods of like kind quality exported at or about the same time to buyers in the same destination country, or in its absence, another destination country adjusted in accordance with subrule 2. What does subrule 2 ask you to adjust? Difference in dates, commercial levels, quantity levels, difference in composition, quality, design, etc., and difference in the domestic freight and insurance charges depending upon the place of exportation. Yes, Sanjay, you are very correct. Your observation is correct that here they have not even given the list of expenses charges to be added like how we have rule 10. The reason is simple. See, export hardly you have limited, means you can even count on your fingers that many goods are there. And for them anyways, the value is more or less means determined. So practically these rules do not come into picture much. Computed value method, it is your cost sheet method, which says that, and now here it is more possible because the exporter is in India, the manufacturer is in India. So you can take the costing details from him and get the costing done. Then coming to residual value method, what it says, subject to rule 3, where the value of export goods cannot be determined under rule 4, 5, that is any of the above rules, the value shall be determined using reasonable means, consistent with the principles and general provisions of these rules, provided the local market price of export goods cannot be the basis. So again, what you will do, same thing. You will take the above rules, your value, that is transaction value, value by comparison or computed value, and you will try to make some small adjustments here and there to make it acceptable. Next, exporter shall furnish declaration relating to the value. And again, the officer has power that where he has reasons to doubt, that he is doubting whatever details you are given as to the truth or accuracy. In that particular case, the exporter will, the proper officer will have the power to reject the value, that is the transaction value given by the exporter. Further, at request of exporter, the proper officer shall intimate the exporter in writing the grounds why he is doubting and give him reasonable opportunity. And again, they have given the list of what could be the way or what could be the reason for doubting and how it can be
remote. So all these things are very similar to what we studied in import valuation. Correct? So students, with this, we have completed this topic majorly. Please focus on all the import valuation rules. Please go through these sums. This is a very scoring topic. You have some very good questions given in our module. Plus, you can refer our past exams, MTP, RTPs uploaded in our portal. Please refer them because this is a very good scoring chapter. Other chapters are theoretical, so many times as students, it is burden for us to remember, but this is a practical chapter, and as you see, there is not much things which is technical or which has to be learned. Yes, few things you have to keep in mind, like buying commission not to be added, then 20% rule for airfare, etc. But barring that, I think other things are manageable, right? Yes, Sanjay, it may range between 6 to 8 marks depending upon the level of question, the number of adjustments there. Fine. So I think we can conclude. So thank you very much. And let us connect again for further chapters. I think our next class will be Sunday. So let us connect again. Thank you. Thank you very much. Ashok ji, we can conclude. Thank you, Ashok ji.